Hello, welcome to Latest Wealth. I am Kailash here, financial advisor as well as wealth coach. My dear friends, in earlier classes, we have been discussing about fundamental analysis. How to do the fundamental analysis? To do the fundamental analysis, we learned that we should know how to read the annual reports. In this episode, we are going to learn about understanding the balance sheet, part 2. In earlier episode, we have done with the part 1. This is part 2. If you have not seen part 1, please watch part 1 and come back to this one. Here, in part 1, we discussed about liabilities. This time, we are discussing about what is the asset size of the balance sheet. In the previous chapter, we looked at the liability side of the balance sheet in detail. Yes? Now we'll proceed to understand the second half of the balance sheet, that is asset side of the balance sheet. The asset side shows us the assets of the company own in different forms, right from inception. Assets in simple terms are the resources held by the company which help in generating the revenue. Please keep an annual report with you and refer page number 72. Just keep in your hands. Just look at annual report, page number 72. See here, it has shown assets. Now you can see that asset side has two main sections. One is non-current assets and current assets. Both these sections have several line terms. Of course, there are some notes is also there. Just you need to refer the notes. Already we have discussed what is the importance of the notes. Now we will look into each one of these line items separately as individual. One is non-current assets, that is fixed assets. In earlier chapter we learned that these are non-current assets talk about the assets that company owns, the economic benefit of which is enjoyed over a period beyond 365 days. Remember, an asset owned by the company is expected to give company an economic benefit over its useful life. If you notice, within the non-current assets, there is a subsection called fixed assets. See here, fixed assets is there, with many line items under it. Fixed assets are assets, both tangible and intangible, that the company owns which cannot be converted to cash easily or which cannot be liquidated easily. For example, fixed assets are land, plant, machinery, vehicles, building, etc. Whereas intangible assets are also considered fixed asset because they benefit companies over the long period of time. Just observe, all the line items with fixed assets have common note, that is note 10. Of course, we are going in detail of the note 10. What is the importance of note 10 here? My dear friends, please understand, each annual report will have different notes. That's what very initially we said. In this, they have mentioned about number 10. If you go in to check in another financial reports, that may be in note 15, we don't know. Here, now let us go and refer page number 72 of annual report of fixed assets of Amar Raja Batteries Limited. Come on, open the page number 72. Just keep it ready with you. See, the first line item, tangible assets, is valued at rupees 619.8 crores. Tangible assets consist of assets which have a physical form. In other words, these assets can be seen or touched. Actually, this usually includes plant and machinery, vehicles, buildings and fixtures. Let us go into next line. Next line item reports value of intangible assets. Hope you remember, intangible assets means which you cannot touch, which you cannot see physically, like a trademarks, licenses, patents, softwares. These are valued at rupees 3.2 crores. Intangible assets are assets which have economic value but do not have physical nature. These usually includes patents, copyrights, trademarks, as I said, designs, etc. Remember, when we were discussing profit and loss statement, we discussed depreciation. Do you remember? Depreciation means the way of spreading the cost of acquiring asset over its useful life. That means now you are purchasing for 1 lakh, the life may be for 5 years, every year 20,000 rupees you are spreading, because the value of the asset deplete over time. As the asset lose their productive capacity due to outdated or physical wear and tear, this value is called depreciation expense, which is shown in the profit and loss account and balance sheet. all the assets should be depreciated over its useful life. Keeping this in mind, when the company acquires an asset, it is called gross block. Please understand, gross block. Depreciation should be deducted from the gross block, after which we can arrive at the net block. See, net block is equal to gross block minus accumulated depreciation. Please understand and be careful about the term accumulated is used to indicate total depreciation value since the incorporation of the company. That means when the company has started, from the day of start of company to till date, that's called depreciation value. Just see here, tangible assets are rupees 619.8 crores and intangible assets are 3.2 crores. Please remember very carefully, company is reporting its net block, which is net of accumulated depreciation. Please have a look at note 10, refer page number 87. You can have these details. Note 10, refer page number 87, which is associated with fixed assets. At the top of the note, you can see gross block, depreciation or amortization, and a net block being highlighted. Just see two net block numbers which tallies with what was mentioned in the balance sheet. See the net block numbers, what they mentioned in balance sheet, it should tally. Now, let's go into a little bit more detail, more interesting aspect on this note. Notice under tangible assets, you can see the list of all assets company owns. See that list, all the assets company has owned. For example, the company has listed buildings as one of its tangible assets. See here, buildings as a tangible assets. As of March 31st, 2013, that means financial year 13, ARBL reported the value of building at 93.4 crores. During the financial year 14, the company added 85.8 crores worth of building. This amount is classified as additions during the year. Further, they also wound up 0.668 crores worth of building. This amount is classified as deductions during the year. Hence, the current year value of the building would be very simple. Previous year's value of building plus addition during this year minus deduction during the year. When it comes to numbers, value of building will be previous year's value of building is 93.4 crores plus added is 85.8 crores minus deducted is 0.668, so the total value of building would be 178.5 crores. You can notice this number being highlighted in blue in that image. Do you remember this is the gross block of the building? From the gross block, one needs to deduct accumulated depreciation to arrive the net block. Just see here, we have highlighted the depreciation section belonging to building. As of 31st March 2013, financial year 13, ARBL has depreciated 17.2 crores, to which they need to add 2.8 crores belonging to financial year 14. Adjust 0.37 crores as the deduction for the year. Thus, the total depreciation for the year is, see the equation, previous year's depreciation value plus current year depreciation minus deduction of the year. Here, see the previous year depreciation value is 17.2 crores, current year's depreciation is 2.8 crores, and deduction for the year is 0.376 crores. Total depreciation of 19.736 crores. This is highlighted in red on the screen, just see here. So we have building gross block at rupees 178.6 crores and a depreciation at 19.73 crores, which gives us a net block of 158.8 crores. That means 178.6 minus 19.73. The same has been shown. Once again, look at the note 10. The same exercise is carried out for all the other tangible and intangible assets to arrive at total net block number. The next two line items under the fixed asset are capital work in progress, that is CWIP, and intangible assets under development. CWIP includes building under construction, machinery under assembly, etc. at the time of preparing the balance sheet. Hence, it is aptly called as a capital work in progress. Let me repeat, capital work in progress. This amount is usually mentioned in net block section. CWIP is a net work that is not yet completed, but where capital expenditure has already been incurred. As we can see, ARBL has rupees 144.3 crores under CWIP. Once the construction process is done and the asset is put into use, the asset is moved to tangible assets under fixed asset from CWIP. CWIP means, let me explain once again, capital work under progress. అంటే ఏదైనా వర్క్ కన్స్ట్రక్షన్లో ఉన్నప్పుడు వచ్చేది. The last line term is intangible asset under development. This is similar to CWIP, but for intangible assets, the work in progress could be patent filing, copyright filing, brand development, etc. This is at a very nominal cost of 0.3 crores for ARBL. All these costs are added to arrive at the total fixed cost of the company. Now let us go into next, non-current assets. Like a non-current liabilities, here non-current assets. Beside fixed asset, under non-current assets, there are other line items. Well, just look here. Non-current investments are investment made by ARBL with a long-term perspective. This stands 16.07 crores. The invest may be anything. For example, buying a listed equity shares, because one company, when they are running in the profits instead of keeping ideal, they keep and invest in some other companies. Like earlier we are shown, like Tata McGraw invested in another company, S&P invested in Chrysler. Like this, they started investing. That may be or minority stake in other companies, or they may take over other companies, or debentures, or they may invest in mutual funds. Like this. Note 11 is very, very big. So what you can do is you take the book and start reading and observe it. And please refer page number 88. Note 11 in page number 88, which will give you full idea. Like this, for every annual report there will be notes. Notes is also very, very important. Balance sheet is important. Profit loss account is important. And cash flow statement is also important. See, the next line item is being long-term loans and advances, which stand at 56.7 crores. These are loans and advances given out by the company to other group companies, or employees, or suppliers, or vendors. Any loan. For example, when the company produces some items, they will be giving some items on loan to the distributors, or some of the retailers, or some of the dealers, or some of the suppliers also they will give, because if they are supplying item. The last line item under non-current asset is non-current assets, which is 0.122 crores. This includes other miscellaneous long-term assets. Now let us go into current assets. What is current assets? How to deal? Similarly, just like a current liability, current asset. Current assets are assets that can be easily converted to cash, and the company foreseen as a situation of consuming these assets within 365 days. Current assets are the assets that company uses to fund its day-to-day operations and ongoing expenses. Generally what happens? The most common current assets are cash and cash equivalents. Because when you are running a small business also, you keep some cash ready. Everything you can't keep in gold, you cannot keep in real estate, you cannot purchase furniture with all the cash. So equivalents, inventories, receivables, short-term loans and advances, and sundry debitors. Just see here, here's the snapshot of current assets of ARBL, page 72. Refer page number 72. They have given clear item. The first line item on current asset is inventory, which stands at rupees 335.0 crores. Inventory includes all the finished goods manufactured by the company, raw material or raw material in stocks, goods that are manufactured incompletely. Inventories are goods at various stages of production and hence have not been sold. When any product is manufactured in a company, it goes through various processes from raw material to work in progress to a finished good. Correct, na? Any company, when they are doing, there is a process. Instantly, within one day, they may not be able to produce. Some things they will take a process of 2 to 3 months. For example, if it comes to real estate company, bricks, sand, material, some of the equipment, they all come under current assets. So until the building is completed, they cannot sell the building. So whatever they required for the building construction, that comes under current assets. Just look here, they have shown in note 14 what are all the inventories they are having. Just see note 14 in page 89. Now you can see bulk of inventory value comes from raw material and work in progress. Raw material means any product, if you want to create a new product, some raw material is needed. Suppose if it is a building construction, as I said, bricks, cement and sand, steel are the raw material. Next line item is trade receivables, also referred to as accounts receivables. This represents amount of money that company is expected to receive from its distributors, customers and other related parties. Just see here, trade receivable for ARBL is rupees 452.7 crores. That means even in the small business also it happens. You supply some material to somebody, he may give money after 1 month. So what you do? You write down in somewhere, na, I have to receive money from him. That is called trade receivables. Next line item is cash and cash equivalents, which are considered most liquid asset found in balance sheet of any company. Cash comprises of cash on hand and cash on demand. There are two terms, cash on hand and cash on demand. Actually, cash equivalents are short term, highly liquid investments which has maturity date of less than 3 months from the acquisition date. This stands at 294.5 crores. Please refer note 16, page 90. The note 16 is associated with cash and bank balance as we are showing on the screen. Now you can see the company has cash parked in various types of accounts, different types of accounts. If you look at the note 16, you can see different types of accounts. See here, cash and cash equivalents as per March 31st, 2014 as per March 31st, 2013. In current accounts, 156 crores. In deposit accounts, 2445.79. In exchange earning foreign currency, 56.65. Checks and drafts in hand, cash in hand. The next line term is short-term loans and advances that the company has tendered and which is expected to be repaid back to the company within 365 days. It includes various items such as advances to supplier, loans to the customer, loans to employees, advance tax payments, income tax, wealth tax, etc. Just see here, it is shown as rupees 211.9 crores. The last line item in asset side is, in fact, balance sheet itself. This is the other current assets which are not considered important, hence termed as other. This stand as 4.3 crores. To sum up, the total assets of the company would now be, one is fixed assets plus current assets. Here fixed assets are rupees 840.831 crores plus current assets are rupees 1298.61 crores. That is equivalent to rupees 2139.441 crores, which is exactly equivalent to the liabilities of the company. Please understand, in earlier we said that total assets should be equal to total liabilities, right? With this, now we have gone through entire asset side of the balance sheet, and in fact almost we have gone through what is what of entire balance sheet. Now let us look at entire balance sheet once again. Refer page number 72 of annual report. Just look here. Now you can see above, the balance sheet equation holds true for ARBL's balance sheet. Asset equal to shareholders funds plus liabilities. Hope you remember, in last few chapters we have only inspected balance sheet and profit loss statements. My dear friends, here just we have gone through what is meant by profit loss account and what is meant by balance sheet and what are the contents, what are the ingredients and what is the terminology. We are not analyzed, still analysis has not done whether it is good or bad. We'll do same when we are going into financial ratios. When we go into financial ratios, we'll do it. So in coming classes, we are going to deal that one. See, next coming chapters, we are going to look at the last financial statement, which is the cash flow statement. However, before concluding this chapter, we have to understand that many ways profit loss account and balance sheet are interlinked and they are interconnected. Let us see what is a connecting profit loss and balance sheet. Let us focus on the balance sheet and profit loss statement and multiple ways they are connected. One, they are interlinked. Just look here. Connecting profit loss and balance sheet. Left side is profit and loss statement and right side is balance sheet. Sales revenue, they will turn as receivables and cash balance. Operating expenses, in balance sheet it will be like inventory and trade payables. Depreciation and amortization, it will turn into accumulated depreciation. Other income, here it will come as investments. In profit loss statement, finance cost. In balance statement it is a debt. In profit loss statement, PAT, profit after the tax. Next, this will be like a shareholders equity. See, on left side we have line items on typical standard financial statement. On right side we have some of the balance sheet items. Now earlier we know that what are the line items means. However, now we'll understand how the line items in profit and loss and balance sheet are connected to each other. To begin with, consider the revenue from sales. When company makes a sale, it incurs expenses. For example, if the company undertake an advertisement campaign to spread awareness about its product, generally companies will spend a lot of money. When the competition is more, they spend more money. When the new product is there, they'll spend more money. When they know that competitor is going to come in with new product, then they spend a lot of money. The money spent tends to decrease the cash balance. Also, if the company makes a sale on credit, that means receivables, the account of receivable goes to higher. Now, operating expenses include purchase of raw material, finished goods, and other similar expenses. When a company incurs these expenses to manufacture goods, two things happen. One is, if the purchase is on credit, generally they do purchase in credit only, then the trade payable go higher or accounts payable go higher. Two, the inventory level also get affected. Whether the inventory value is high or low depends on how much time the company needs to sell the products. When companies purchase tangible assets or invest in brand building exercise like intangible assets, the company spreads the purchase value of the asset over the economic useful life of the asset. This tends to increase the depreciation mentioned in balance sheet. Do remember, the balance sheet is prepared on flow basis. Hence, the depreciation in balance sheet is accumulated year on year. Please note, depreciation in balance sheet is referred to as accumulated depreciation. Now let us come to other income. Other income includes monies received from the form of interest income, sale of subsidiary companies, rental income, etc. Hence, when companies undertake investment activities, other incomes tend to get affected. As and when the company undertakes debt, it could be short term or long term, the company obviously spends money towards financing the debt. The money that goes towards the financing debt is called finance cost or borrowing cost. Hence, when the debt increases, the finance cost also increases and vice versa. Finally, as you may recall that profit after tax adds to the surplus of the company, which is part of the shareholders' equity. Now, let's revise what we learned today. My dear friends, if you are unable to follow, watch 3 or 4 times. It is your property. Until you get clarity, don't go into next episode or next class. Let us revise what we learned today. The asset side of the balance sheet displays all the assets of the company owns. 2. The assets are expected to give economic benefit during the useful life. 3. Assets are classified as non-current and current assets. 4. The useful life of non-current asset is expected to last beyond 365 days or 12 months. 5. Current assets are expected to pay off within 365 days or 12 months. 6. Assets inclusive of depreciation are called gross block. 7. Net block is equal to gross block minus accumulated depreciation. 8. The sum of all assets should be equal to sum of all liabilities. Only then balance sheet is said to have balance. 9. The balance sheet and profit loss statement are inseparable. They are connected to each other in many ways. My dear friends, hope you gained some knowledge in understanding the balance sheet as well as how to read annual reports. My dear friends, still we are not analyzed whether it is good or bad. Just we learn what is what. In next coming chapters, we are going to analyze which is good, which is bad. And thank you for watching. Please follow step by step. If you are not followed, watch 3 or 4 times and please enjoy the process. More you enjoy the process, more benefits you are going to get. And watch once again with annual report. Enjoy the life. Be wealthy. Thank you. Let's meet in next class. Krishna Kailas is logging off. Bye bye and have a nice day.